Morning, everyone. Morning. Can we get started, please? Right, so today we will cover the remaining few chapters in terms of revision, and then we probably can get a start on the assignments as well today, okay? Right, so I asked you yesterday have you got any questions, any areas of clarification? We can start there. You all okay with everything? Okay.
So just in terms of when we're doing the statements, so first I want to know what's the order of the statements. I know the first one is income statements.
Okay, a good question. Typically, in the past, we used to always start with an income statement. But now you'll see that the order typically now is actually the balance sheet, statement of financial position. When you look at annual financial statements, you'll see that they start with the statement of financial position. Then they normally go through to the income statement, statement of comprehensive income. And then before, they'll probably then go into the statement of change of equity, change in equity. Statement of cash flows, and then the notes to the financial statements. Now that is typically the order that one would see it. But per se, it's not if you start with an income statement first, it's not a train smash. All right, any other questions on any of the other sections? Okay, then maybe let's just continue with some of the revision before we hit the assignment. If I had to give you this example of various working capital balances, and I just had to ask you, have a look at this, and then how would you assess this in terms of the liquidity of this organization or of this business? All right? So I'm saying that this business inventory balance is R500,000. Debtors with an average debtors days of 60 at 1.2 million. A cash balance of 100,000. And then on the non-current liability side, we've got creditors balance of 1 million, average 45-day payment, a bank overdraft of 800,000, and a tax bill owing to SARS of 300,000. Just spend a minute, and how would you assess that in terms of liquidity? So if you were managing this business, would you be happy with the liquidity situation? Would you be a little concerned? Would you be distressed? Okay. So remember, when we look at liquidity, are we looking at the short-term or the long-term in the company? Short term, no? Yeah. So remember, liquidity is the short term, whether you have sufficient cash resources to meet your short term obligations, right? Okay, so who thinks that the liquidity is fine in this business at this point in time? You think the liquidity is okay? In your view, maybe differ, think that there's maybe a bit of distress in the liquidity of this organization?
I just want to understand. So creditors are the people who owe them, or the people that they owe.
Okay, so remember, yeah, we've got to get this terminology right so we all understand it. Okay, so this is the company, right? So the debtors are those customers of the business that owe the business money, right? So that typically arises from credit sales, right? So important, these are essentially credit sales, right? And that debtors arise from that. And then the creditors are those suppliers that the business owes money to. So these are basically credit purchases.
So I changed my mind. I think the business is actually in trouble because the people that they owe is over what they actually have.
All right, so you're saying that this creditors is greater than
The total
the
is
total.
greater than what the business actually owes.
All right, did you guys, so that's one important point, is that the total of this portion of non-current liabilities is in fact higher than the non-current assets. Okay? That's valid, right? You've probably got more short-term liabilities and obligations than you do in terms of short-term assets. So so that's valid. Yeah. What else do we notice on here? Remember the rate. Okay, so the debtors are more than the cash. That's true. That's true. Implication though for liquidity, perhaps. What would that imply in terms of liquidity of the organization? You're on the right track.
It means our liquidity is low.
Yeah. So current liquidity of only 100,000. Only 100,000. Your point is very valid as well. Is that on average you're still going to take another 60 days to turn this debtors into cash. And ultimately you want cash, right? To meet your commitments. Because look what your commitments are. Creditors, right? Your bank overdraft. Okay, so effectively the bank can call this overdraft. It's on demand. And then you've got a bill for SARS. Right? So that's another valid point, is that the debtors still going to take some time to turn that into cash. So your actual cash resources are very, very low. You can rely on your bank overdraft, but if I had to tell you that your bank overdraft limit was 800,000, you can see that there's no further scope for more borrowings. You can't go to the bank and say, right, you know, I want more bank overdraft. You can go and request it, but it might take time. Okay, right? And then look at this. Remember the
Is the bank overdraft the money that the bank can borrow?
correct. So that's the short-term facility. It's normally money over a short term that the bank will grant you credit. So you're right. This is not a long-term loan. This is just a short-term portion. Correct. Yeah. But can you also see the mismatch? Remember we spoke about working capital. We would like to collect cash from our debtors typically before we have to pay cash over to our creditors. And you can see that there's quite a gap between those two payment periods, right? Okay. So in terms of ratio analysis, you look at your debtor repayment period, 60 days, so on average 2 months to collect. But look, you're having to pay your creditors in a shorter time than what you collect your debtors. There's a 15-day difference there, 2 weeks on average. Okay? So that's also not a great sign for this liquidity position here. Any other comments? Can you see that there might be actually a little bit of a liquidity issue in this business, right? They've got definitely more commitments than they do in terms of ready available cash.
How is those 60 days and the 45 days a problem?
Okay, so remember the debtors are people that owe the business money. So they're going to pay us this 1.2 million over an average of 2 months. So we have to wait for 2 months on average to collect our money. But we are paying our creditors in a shorter period of time. So where are we going to get that money to pay these creditors if we have that mismatch, right? We've utilized our bank overdraft facilities, so we're pretty stretched there. SARS doesn't really like to wait for their money. Okay, so when there's a due date for SARS, they're going to come knocking for that money, right? Otherwise, there are huge penalties and fines. Okay. Sorry.
With the 60 days, does it mean that the 1.2 million clears only on that 60th day, or does it clear within the 60 days?
Okay, so if we to answer that question, I'm going to just refer you to that actual ratio. So when we look at debtors' days, right, we are looking at essentially the payment period of our debtors. So that is an average payment period. So it's not that I wait, that I get this money at the end of 60 days. On average, that is how long it will take. But remember, every day I'm having new sales. So on average, those sales I'll collect over 2 months. Okay? So effectively, what we're looking at in terms of the formula for the trade receivables days would be trade receivables divided by your sales, so your debtors divided by your sales, times 365 days. Okay. All right, so that is quite an important ratio, the debtors' days. Okay. All right, so I think to sum up, if I had to look at this position, there would be actually a bit of a if I was the finance manager, I'd be a little concerned. I should be maybe a little bit more than concerned, you know, if this was the situation. Sure, there's other information that you may require, obviously. What are the sales amounts? How much potentially are there cash sales? But if you look at my inventory over here, that's another guide. Inventory is also going to take a bit of time, right? You may be in a manufacturing concern. You have to turn this inventory through the manufacturing process into finished goods. You can only then sell it at a future date, right? And even if you were able to mark this up, remember inventory being part of your cost of sales? So even if you were able to generate 100% profit on this 500,000, right? That's only another 500,000 over time. Okay. So you may have actually too little inventory in this business to generate your future sales. Okay. So that's another indicator. With more information, you could analyze it further. But just looking at 500,000 in relation to your debtors and creditors, it's not a huge amount. So it's not that there's a whole lot of stock that you can sell to generate further cash. Okay. Your question?
I was just concerned about that 2 million and 1 million and 100,000. If the business collects all that money, they will be having that 1 million and 800,000. If they want to have their money.
That's correct, yes. So if they were able to...
Supposed to pay how to spend the 2 million and 100,000.
Sorry?
What I'm saying is that 1 million and 800,000 is a businessman that they should be paying.
Right. When they're able to collect all their debtors and sell the inventory, they can turn that into cash, yes.
So how about that 2 million 100,000?
Correct. Correct. So remember, you know that your obligations are 2.1 million, right? You know that that's what you owe on a short-term basis. But can you see that already you have a shortfall on this side of your balance sheet, right? You can see that this is more than this, right? That's an indicator of an issue. You may not collect all this 1.2 million, right? I mean, it's very possible you won't collect all of it, right? So, in fact, this 1.8 could be less. And then you've got even a wider gap between this and this. This inventory, you may not be able to sell some of it, right? Maybe obsolete, maybe damaged, whatever, right? You may not be able to sell all of this. So this is a known liability. You know the business owes this amount of money. But it's not 100% certain that you're going to collect all your 1.2 million in debtors, right? And it's not totally certain whether you're going to be able to convert this inventory into a saleable product and sell all of it. Hence why, from a liquidity point of view, a little bit of distress here. Without further information, just as it's presented, you can see that for this business to meet its short-term commitments, it's going to struggle. It's going to struggle. All right. So that's from a liquidity point of view. Okay, moving to something quite different. One of the questions that was asked in some of our previous meetings was the issue of the annuity. Okay? And I think the best way to illustrate the annuity is through an example. Now, what is an annuity? Anyone? Okay, right. Yeah, you're right. Often you have the word retirement annuity. So that's when you retire, you have the monthly payout from that previous investment, right? Yeah. But it doesn't have to only be on retirement. You can invest money now, and over a certain amount of time, once you've invested that money, you can be repaid that money in the form of what they call an annuity. Okay? Right. Now, there are essentially two types of annuities. In this example, it's what is called a fixed stream annuity. So you can see that for years 1 to 5, I'm receiving a fixed amount of 10,000 Rand per annum. right? Fixed. Okay. However, this amount that I receive doesn't have to be a fixed stream, right? It can be a variable stream. So 1 year I could receive 10,000, the next year 5,000, then 12,000, etc., right? But this is a fixed stream annuity. Now, I'm receiving these amounts into the future, right? Okay? From year 1 to 5. So that's into the future. So I would like to know, what is this 10,000 per annum over 5 years? What is that worth today, right? And therefore we need to compute the present value, right? Okay. So now let's do this example together, so we're able to do it with the tables that you have. So at the back of your study guides, or on the actual handouts, I think, that were given to you, we have the fixed annuity tables, right? So let's say this was a 10% annuity. So we can use two tables to get to a quick answer on the fixed stream annuity. Okay. So let's just compute this together, right? Or you have a chance when you work in your teams to get to the answer of what is this present value of this annuity. And let's work off the tables, right? Let's complete this. Are there any questions on this exercise? How do we get to that? The 37. Okay. All right. So remember, the principle is that the 1 rand in the future is not worth 1 rand today, right? Because you rather have the 1 rand today, you can invest it, okay? So the factor for a 1-year annuity at 10% is 0.9091. Are you able to find that on your tables? No? The first one is? Okay. So if you found the first one, then the next one should be just the number below that. No? Is that not what I use?
Yeah, you have the plus.
Oh, all right. Okay. Yeah. So the tables. Okay, the table that I have in the study guide versus the loose table that you have has got a 3. I have a 4 decimal factor on my one, whereas you guys, I think, have a 3 decimal. Okay. So that's the only difference. It's the same. It's the same. It is the same one. Yeah. All right. All right. So if the return is 10%, what we are saying is that the 10,000 that I give you next year, the value of that 10,000 today is only 9,091 Rand. If you can achieve a 10% return. Okay. Right, and then for the next 4 years, you just multiply the 10,000 by the factor. Okay. Now, that is applying the factor to each individual year. Where you have a annuity that is a fixed stream annuity, the other way to compute it, right, is to use the annuity factor, right? So if you look on your tables, the one that is called the present value interest factor for 1 Rand annuity discounted at 10% for 5 years, right? You'll see that the annuity factor is 3.7907. Okay? So a quick way of computing it would have been to then take the 10,000 multiplied by this annuity factor would then give you the same answer. And all it means, if you want to check it, is that if you add these individual factors, if you add them together, you actually do, then it does add up to the annuity factor of 3.7907. Okay. So you can do this with a fixed stream annuity. But if the amounts differ each year, you won't be able to just take the one annuity factor. All right. You'll have to take the individual ones each year. All right. Everyone comfortable with this? Okay. Which ones? Which figure? This one? Okay, it's from the table, from your table under the. So under 10% is 0.9091. Oh wait, no wait. So you've got the. Okay, sorry. This one is the annuity table that adds up to the 3.7907. See if you take. You see it adds up to 3.7907? Okay? So that's the annuity factor when you add it together each year. If you're looking for the individual years, you have to utilize table A3. Here we go. That's this one. All right.
So that's 9091 8264. Okay, those are the numbers. Okay.
Yeah. Yeah.
So we add them together to get the same number.
Correct, correct. Or you can just go to, because it's the same amount each year, you can use each year, or if you know that it's the same amount each year, you can go then to this other table, and you can see under 10% for 5 years. Oh, wait, keep I don't know, this thing is, there we go, 3.7908. Okay, you can see.
It all of this.
No, it's not adding all of those. It's actually adding that one to the 0.8, to the 0.7, to the 0.6, to the 0.6. Comes out to the 3.7. All right, so if you take the individual years, these are the individual years, right? If you want to do a shortcut, these years add up to the 3.7907, right? But you can go and look on the table, on the different table, on that one I showed you now, to find this number. All right, so then you. Question?
Besides inflation, what else affects the time value of money?
Yeah, so the major impact on time value of money is really the interest rate. It's the interest rate. And the interest rate takes a lot into account. One of it will be inflation. Right, yeah. Good.
can I deduct about my investments?
All right, so if you're offered an annuity that pays out 10,000 for the next 5 years, right? You know that if you have to pay for this today, you would pay 37,907, not more. Because if you paid more, it's not worth it. So you would actually want to pay a bit less, and then you get this return over the next 5 years. Because as you say, your interest rate is fixed now at 10%, and as you say, it could vary. It could vary. Inflation could change, etc., right?
So it's worth it.
Sorry?
So this particular annuity is a good one.
Oh, no, well, it's not good or bad. It's not like our example. So remember, we looked at the practical application of this, right? And where we used the time value of money was in our investment and capital budgeting. That is where we then came up and said, right, what is the value of my cash flows? In this instance, it was 101,000. What was my original investment up front? Okay? So if I only had to invest 90,000 and I received these cash flows, is the investment worth it? And in this instance, it was, because you were your return, your cash return, discounted, was higher than your original investment. Okay? So this is the application of that. What I just showed you now was just the calculation. How you apply it in terms of capital budgeting and investment decision making. All right. You will then look at payback periods, discounted payback period, your net present value, your IRR, and your PI, your profitability index. Okay. Does that make sense? Yeah. So that example that I've just done is not in terms of working out a profit or a loss. It just shows you what that value is. Okay. Okay. All right, any other questions? Okay. All right. The only other section that we needed to just revise were the ratios. Okay. So in the study guide, there are quite a few different categories of ratios. Okay. Let's just run through them so that we understand them, right? So one of the key items that we want to establish in any business is your profitability, all right? And we have quite a number of profitability margins. We have the gross profit margin, the EBIT margin, and the net profit margin, okay? So are there any questions on those margins? Are you able to compute them? Okay, you're right. If someone asks you about profitability, you'll be able to work those margins out. All right, so then if you know on the profitability margins, okay, so the other two key items under profitability would be your return measure. Something like return on equity measures what you are returning as a shareholder, what return you are receiving as a shareholder, right, on the amount of money that you've invested in the company. if you are returning or being returned 10% on your money, right? That's an important measure because you're going to compare it to what? Right? So if this business that we are in returns to the shareholders 10%, will you be happy with that return? What are you going to compare that 10% to? You're going to compare it to other returns in the market, other opportunities in the market, right? If you can earn 10% or 12% in another business, right, that is maybe lower risk, you might want to look at that alternative opportunity if you're only receiving 10% in your current investment, okay? So your return on equity is the profitability ratio that you'll use to determine that return, okay? The next category of ratios was the turnover ratios, okay? Return on equity is the profit after tax divided by the total shareholders' funds. Total shareholder funds would be your right, so total shareholder funds you would see that under your equity side of the balance sheet, right? All your share capital, all your retained earnings, okay? And then turnover. Essentially, you invest into assets so that those assets can generate the business turnover, right? Because without turnover, you can't meet your expenses, right? You can't turn that turnover into cash flow. Those are the two very important elements of turnover. Okay. Remember, turnover, sales, income might be used interchangeably, so it's the same, right? Okay. Then very important as well, we often want to see what are our debtors' days and our creditors' days. So those two formulas will tell us what our trade receivables turnover days are and creditors turnover, well, not turnover. If we use turnover to work out our debtors' days, what do we use to compute our creditors' days? Would we use turnover as well? Okay, just please just answer this. When we work out our debtors' days, we look at sales versus our debtors, right? When we look at creditors' days, we obviously look at our trade payables, our creditors' balance. Do we then compare that to sales as well? No. We'd rather compare it to our cost of sales, our purchases, right? Okay, because we pay creditors for the purchases, for the cost of sales, right? And our debtors pay us for the sales. Okay, so that's an important distinction between the two. Okay. All right. Inventory turnover, we look at how quickly can we convert our inventory into a finished product so that we can ultimately sell that product and generate cash, right? So those are the inventory turnovers. Sorry, inventory turnover ratios. Liquidity ratios, what would we look at to determine liquidity? Right, we would look at things like our current assets versus our current liabilities. And then we have something called the quick ratio. What do we eliminate from our current assets to compute the quick ratio? Inventory, right? Because inventory is going to take a bit longer to translate into cash. Okay? So we remove this. So look what happens when we actually remove inventory out of this example, right? We are then comparing an amount of 1.3 million against 2.1 million. So from a quick ratio point of view, definitely this is a distressed liquidity situation. All right. Some people call their quick ratio the liquid ratio as well. I think that's the term they use in the assignment. Okay. Debt to equity ratios. Right. I think we've looked at that previously as well. Formula for? Which one? For the debtors ratio or the debt to equity ratio?
What's the difference between the two?
Okay, that's a very broad question. Okay, so remember when we're talking about debtors, okay, we are talking about debtors as a current asset. Okay, so how long will it take for our debtors to pay us? That's important, right? Debt to equity is in terms of the capital structure, how much debt there is in the business versus how much equity there is in the business. Okay, so debt and debtor, slightly different, right? Debtor is the amount of money that's owed to us for credit sales. Debt is how much borrowings the company's taken on, loans, etc., right? So that is debt to equity. Right, remember we had a look at the formula for debt to equity, either as a ratio, 1:1.67, or as a percentage. Okay. We utilize this debt to equity ratio to compute our weighted average cost of capital, remember? Okay. That's where we needed to know what portion of debt, what portion of equity we had in our capital structure. Right, and then there was a question yesterday from the assignment. The question was, we only looked at a twofold WACC structure, equity and debt. If we have a third item like preference shares, okay, the principle remains the same. We look at our share capital, we weight it. We look at preference shares and we weight it. And we take the debt and we weight it to get to our WACC. All right? We do not add the preference shares to the share capital to work out the WACC. Okay, that's very important because they have different weightings and they have different costs of capital. So don't go and add the preference shares to your share capital, right? You'll come out with the incorrect answer. The reason being that the preference share cost of capital might be different to your share capital cost of capital. Okay. All right. Okay, so we know about the weighting of our equity and debt multiplied by the cost of equity and debt. Adding those two numbers together gives us our weighted average cost of capital. Okay. So those are our debt to equity ratios. And the debt to equity ratios tell us about the solvency of a business. So we looked at the liquidity of a business, right? The short-term commitments. We have certain ratios that we look at to help us analyze it. To analyze the solvency, the long-term feasibility and sustainability of a business, we look at the debt-equity ratios, right? That informs us as to the solvency of a business. Okay? Not the short-term, the longer-term solvency. Yeah. Okay, so common stock is very much an American term. Okay, so when you see common stock, what they're referring to there is what we might call share capital or equity. Okay, so it's the same. Okay, answer your question? Yeah, sure. Okay, and then also very important, the cash flow ratios. Okay, we can look at those as well. That tells us how quickly cash is being, how quickly working capital is being converted into cash. How much cash do we have to pay our interest, etc. Right? How much cash do we have to pay our dividends? Right? We don't want to be paying dividends out of borrowings. Right? That's not a good principle. We want to pay dividends out of our profits. Okay. Right? Any questions on the sections, on the various sections that we've covered? Okay. All right. If not, let's take a break for tea. After that, we'll run through the assignments. All right. Thanks. Just by way of show of hands, who of you are doing the HCBM assignment? Okay. All right. So it's
The questions are different now.
almost half an hour.
Can we swap?
All right. So why don't we run through the HCBM assignment first? All right. But what I would say is that even though it might be different assignments, the issues are similar. So you can still benefit from going through both, right? Okay, I just want to see who am I speaking to then on HCBM. Okay. All right. All right. So let me just check that I have the correct paper. The first question I have is, discuss your understanding of the term financial management. All right. So relatively straightforward, right? A lot of material that you can research, right? We looked at that in the beginning as well. Right, so the type of items we talk about are the three major roles. Okay. Why does a company need financial management, etc. Right? 1.2 just takes it a bit further, says outline and discuss the hierarchy of managerial functions from a financial management point of view. I think you all okay with that? You'll be able to find material on that. Okay. Okay. Question 2 that I have is, discuss the purpose of International Financial Reporting Standards, IFRS. Okay, once again, everyone okay with that? Maybe let's run through one or two items. What would some of the purposes be of the IFRS? Essentially some type of standardization, right? Making comparisons across geographies, across different companies as well easier, right? So when you have a standard body of reporting standards, it gives guidance, in fact more than guidance, on how to treat certain accounting transactions. Because you can imagine if I do it one way and you do it another way, when we compare, we might get very different answers, right? So it provides guidance to the accountants, to the financial managers, all right? List the components of a complete set of financial statements. I think we've run through that a number of times, right? Okay, so we all know that. So include all the 5, include the notes as well, remember, because the notes give more color to these financial statements, right? So include the notes as part of the setup as well, okay? All right, so I think the first 2 questions, you'd be okay with that? All right. Question number 3, a product has a selling price of 15 Rand per unit and a total of 1,000 units have been sold. The cost of goods sold per unit is 10 Rand. Calculate the gross margin. All right, so without redoing the sum, we know what the income statement will look like at that level. So we know we will have a revenue / sales. revenue or sales, right? To compute that, it's a issue of quantity times price. Okay? The quantity that we are selling is 1,000 units. The price per unit is 15 Rand. Okay? So we can work out the sales, relatively simple. So we work out the sales, we work out the cost of sales. Right? One minus the other gives us our gross margin. Gross profit, gross margin. Okay? Okay? Any questions on that? Okay. Okay, question 3.2. A farm tractor is purchased for 60,000. The useful life of the tractor is 5 years, and it depreciates at 20% per annum on a reducing balance basis. Determine the value of the tractor at the end of each year over the 5-year period. Okay, so we've done similar examples in class. Right. This example doesn't have a salvage value. So we know that if it doesn't have a salvage value, we depreciate the full cost value. Okay? So we'll depreciate from 60,000 down. Okay? Major issue to remember on the diminishing balance is that you have to compute the depreciation after each year based on the net book value, right? So it's not a straight line. If it was 20% straight line, it would be 20% times the 60,000. But we know that you have to compute it on the reducing balance method. They ask for 5 years, so do each of the years, right? So do all 5 years. Questions on that one? No? Okay. All right. If we look at sorry, can you just ask everyone? Pose the questions, everyone can benefit from it. Have you got a question on this one? I'm sorry?
Just for calculation.
For calculation. So yeah, it would just be 20% of the net book value. All right? Question number 4. The following items were taken from the accounting records of Bowser Incorporated. The income statement account balances are for the year ending 31 December 2017. The balance sheet account balances are the balances at 31 December 2017, except for the retained earnings balance, which is the balance at the beginning of the year. So what are you required to do? You're required to prepare an income statement and a statement of retained earnings. Okay. Now I think the major question out of this one was, where's the cost of sales? I think that was the major question arising from this question. And as I pointed out, you don't have to have a cost of sales, right? You can take it directly from revenue or income, subtract the expenses, you'll come out to your earnings before interest and tax. Do they have an interest cost here? No, yeah, and so there's no interest cost. So we can go straight down to earnings before interest, earnings before tax. The tax rate is 30%. Okay? Right? And you're given the opening retained earnings, which is 16,310. Add that to your current year profit to get to your retained earnings at the end of the year. You okay with that?
Can you please repeat that, sir?
Right, so remember the layout of the income statement? Right. So we've got revenue, income, sales. If there's no cost of sales, we go directly to our expenses. We get earnings before tax. We know that tax is 30%, so our tax charge will be 30%. We will then have the profit after tax for the year. Don't forget to add the retained earnings at the beginning of the year. So retained earnings beginning of the year. You add those two together, right? Right, and that will give you then your retained earnings end of the year. Right? That gets carried through to your balance sheet. They don't actually ask for a balance sheet, but they do ask for a statement of retained earnings, right? So the chief items in that would be these three. Okay? Okay? Any questions on that? No? All right. The common stock.
Yeah.
All right, you're correct. So the common stock would typically be your equity, right? That would be your share capital, in other words. Okay. So if you wanted to be very detailed, don't forget, in this example, they've actually got dividends, right? So we know that dividends are a reduction of the retained earnings, right? So in this instance, there would be dividends as well. Okay. Okay, so don't forget your dividends, your common stock, which is your equity as well, right? So in fact, they've given you common stock and they've given you additional paid-in capital, right? So you've actually got two. Both of them are equity, but one is paid in and the other one is your common stock, right? So your common stock would be your opening, your additional paid in would be your new shares issued, capital from your new shares. Okay. Okay. Any items there that that anyone's not sure of? I think the major issue there is that some of you have come to me to say, well, can we treat the supply expenses as the cost of sales? If you really want to show cost of sales, fine. Show it as cost of sales, but then say what you're taking as the cost of sales, right? In this instance, supplies expenses. So if you really want to show the cost of sales to get to a gross profit, just show what you're doing, okay? All right, moving on. Question number 5. It's quite a big one, 30 marks. So you're given an income statement and you're given a balance sheet. And then they ask you to compute various ratios. I think important for this question is that you're told to assume that the year is 360 days. So use 360 and not 365, okay? I think that's probably the important one in this question. Another question I've had is, what is this liquid ratio? So the liquid ratio would refer to the liquidity ratios. They already asked under 5.4 for the current ratio. Therefore, I would interpret the liquid ratio to be the asset test ratio. Okay? So current ratio 5.4, take out the inventory to compute 5.5, the asset test ratio. Okay? All right, and I see one other thing that is piece of information that is given is that you are given both the opening stock and the closing stock. And the reason they would do that is that when you get to something like the stock turnover ratio, they're probably looking for you to use average stock. Okay? Just remember that one, average stock. Okay? Okay, moving on to question 6. A firm whose cost of capital is 10% is considering 2 mutually exclusive projects. The details which are follows. Cost and cash inflows. You're asked to compute the net present value, the profitability index, and the internal rate of return. So essentially, this example, right? There's example in the study guide, the one that we did together. Right? So where you have cost, remember that is your investment. That's a negative outflow in year 1. Okay? Or year 0. Okay? The cash inflows each year, they're talking about a cost of capital of 10%. So remember the tables, we actually utilized 10% example as well. So you would have utilize these factors, right? The 10% column factors to work out your discounted cash flows. Right. So your cash flow times your discount factor is your discounted present value. So remember, compare this against your capital investment. Okay. Any questions on that one? On that question? Okay. Question 7.
6.2, sir. There's 6.2 and 6.3.
Right, so all they're asking for is the NPV, the IRR, okay, and then the profitability index. Just remember, when you work this, when you compute this, don't forget to work on the present values, right? Not on the nominal cash flows. Okay? Otherwise, you're going to get a different answer. Okay, so don't forget this important step. You have to convert the nominal cash flow into the discounted cash flow. Same information that you would use to answer all three, 6.1, 6.2, and 6.3, based on the same information. Okay. Okay, so there are 2 ways we can calculate that. Those of you that have got the financial calculators, Okay, you'd enter the discounted these cash flows on your computer. If either you do it on a computer, right, or you do it on the calculators, what you'll be asked to do for an IRR, okay, is to guess what that return is. So in Excel, for argument's sake, they'll say to you, what are your cash flows? So you'll enter a negative, in this instance, 70,000 is your first cash flow, right? Then for the two projects, you have different cash flows for the next 5 years. So you enter those cash flows into your calculator or into Excel, and that says then, guess what interest rate it is, right? Remember, we had to guess here as well. And the way that we guessed here to work out when we thought that the payback would be, is if you remember, we looked at this example, we said 90,000 was my investment up front. When more or less did I expect the payback to be? We expected it to be somewhere between year 2 and 3. Because if you look at the nominal cash flows, after 2 years we received back 80,000. After the third year we received back 90,000. So somewhere in between there we received back our money. Okay? So we know that the interest rate is then somewhere between year 2 and year 3. So if you guess 20 or 30%, then the calculator will return you the correct answer. In fact, in Excel, you don't even need to guess it. They actually just compute it on the cash flows for you. Okay. So maybe if you want to, I can show you that either on your computer or on your calculators. Okay. Okay, question number 7. Okay. The question is, if the risk-free rate equals 4% and the stock with a beta of 0.75 has an expected return of 10%, what is the expected return on the market portfolio? Okay, so we know this is the formula. Okay, so what are we given? We are given the beta, in this instance, 0.75. Risk-free, we are given 4%. So we know that is 4% there. And we asked to compute RM. Okay. Okay, so you all okay with that? We need to compute what is RM. Okay. The second question, 7.2, they're asking for the weighted average cost of capital. So you'll remember I mentioned to you earlier today all you need to do is to take into account that they've got 3 different sources of capital. They've got debt, 45% debt, 5% preferred stock, preference share capital, and 50% common stock, 50% equity, share capital. All right? They tell you then, they give you certain information to work out the cost of capital. In this instance, they give you enough information to work out Gordon's growth model. Okay. So just remember on Gordon's growth model, it's the dividend for the next year. Okay. Over the price of the share currently. So don't forget D1 over P0 plus the growth rate. So you're given that information. Right, they tell you that XYZ expects to pay a dividend of R1.50 per share next year. Okay. Market analysts foresee a growth in dividend in stock at a rate of 5% per year. Right, 5%. So you substitute those numbers into this formula, you'll then get the cost of equity using Gordon's growth model. All right. All right. Okay. So in order to do the weighted average cost of capital, we need 2 major sources of information. We need to know what is the weighting each category carries. In this instance, we've got share capital of 50%, preference shares of 5%, and debt of 45%. Multiply that weighting against the cost of capital, right? And remember, once you multiply that out, you add the last column. 7.5, 2.43, your weighted average 12.9. Okay. Okay, then question 8. Suppose an investor wants to be able to withdraw 5,000 at the end of year 5 and 6,000 at the end of year 6, leaving a 0 balance in the account after the first withdrawal. If he can earn 5% on his balances, how much must he deposit today to satisfy his withdrawal needs? Okay, so what information do we know? We know that they want to withdraw an amount into the future, right? So the future value is 5,000 at the end of year 5 and 6,000 at the end of year 6. Okay? So what are we asked to compute? The present value. So, right? Correct, present value. Okay? So we know what the future value is. We need to now compute the present value. So are we compounding or are we discounting? Right? So we're bringing it from the future back. We're discounting it back to today. All right? And the 2 formulas, if you need the formulas for present value and future value, they are in the study guide. Okay? And then the last question is a theoretical question. Discuss 3 advantages and 3 limitations of ratio analysis. Okay, there's quite a bit of information on that. All right. Everybody comfortable with the assignment? I'm sorry?
It says in the introduction to the survey consists of 10 questions, but there's 9 questions.
Okay, so they say, do they say 10? Yeah, I think that's incorrect. Do the marks add up to 100 for the 9? So it's 10, 30, 40, 70, 70, 70, 89, 89. Yeah, it adds up to 100. Okay, so good question there. It says 10 questions, but in fact there are only 9 that add up to the 100 marks. Okay. All right, so okay, so I'm not get. What is the feedback? Are you okay with this? Finding it difficult? What's difficult? All right, I tell you. I assume that many of you haven't. You obviously haven't completed this yet. You may have started some of it. Okay, so why don't you? Tomorrow I'm available again, right? You can come with the specific questions on these specific questions, and we can work through that. All right? But please try it first. A lot of the calculations are not. I'm not sure if you've copied down the examples we've done together. So between the examples we've done together and the examples in the study guide, I think you'll be armed quite well with this assignment. Okay? There's nothing in here that we haven't covered a few times. Okay? So come back to me, tell me which particular issue you have. We can work through it together. All right. But it's important that you do attempt it, right? It's no good if I give you the answer, right? That's not going to help you. Okay. I'd rather you come to me and say, I'm battling with this. Okay. All right, so I'll be available to do that tomorrow. Okay. Is it a detailed question? Oh. Or can I help you after? Okay.
To confirm something.
Okay.
The profitability index, is this the correct formula or this?
Net present value plus initial investment?
Is it
Over.
minus? Is it plus or minus, or there's no initial?
I'm not sure why they say initial investment again.
Is it not the outlay?
Oh, it's the way they've set it up. So remember, I didn't set it up like that. I set it up with the total present value divided by the. So the 90,000 is the investment, right? And I just divided the present value of the returns. 101 divided by the 90,000 gave me a here we go. Yeah. 1.12. It's greater than 1. Go ahead.
So profitability index, it's the present value divided by the
Initial investment. Yeah.
So the present value and NPV are different in this case.
No, it's the same.
It's the same.
You could call this NPV. Present value NPV.
Oh, so I don't have to say NPV minus this over this.
No, you don't need to do that. You can just say this divided by this gives you the.
The profitability
Yeah.
index.
And just as long as it's greater than 1, it's okay.
Wait, you're saying
The answer must be greater than 1.
so
If it's greater than 1,
0.12,
if it's 0.12, then it's not so good. Because you haven't got your money back. You see, because this says you got your money back plus a profit. If you get less than 1, that means that you haven't even got this back.
but the answer is still correct.
Okay, so all you do is you take your net present value, you divide it by your investment. That's the answer. Okay, that's the answer. That's all you have to do. Okay. All right, so let's go through the BBA assignment. Okay, so just looking at the second page, I see it says 4 questions. So, and then I see actually 5 questions on the assignment. So, please, it's 5 questions. Okay, all right. Okay, should we go through? Everyone okay? Right. So question number 1, functions of financial. Okay, guys, girls, please. Please. So the first question is functions of financial management and decision making. Okay, so very, very similar question, right? Very similar question to what we had up here. Okay, so I think you'll be able to go through that. Second question, create your own examples to illustrate the difference between sensitivity analysis, standard deviation, and coefficient of variance. Did you guys run through something like this? I know that we've gone through a sensitivity analysis. And a standard deviation and coefficient of variance.
To do an example of the sensitivity analysis, but not the coefficient of variance and the other one.
Yeah, because I mean I haven't taken you through the second part of it, the coefficient of variance. You probably, what we've gone through is a sensitivity analysis with a standard deviation, right? But a further interpretation of it. Okay. Let me do this. I'll prepare an example of this, okay? And then run through it with you tomorrow. Okay? Because I noticed, we haven't done the last bit. Well, I haven't. I'm not sure if you did that with. I doubt James took you through that level of detail. Okay. All right, but I mean, okay, if you've done examples, we can work with that too. Okay, but I'll just run through. Let me make a note to bring an example tomorrow of that. All right. Question number 2. Has anyone done question 1.2? Any of you done? You attempted it? Huh?
Yes.
Okay. So you probably just the last bit weren't sure. Huh? Okay, no problem. We'll do that. Okay, question number 2, the framework of financial reporting and financial statement analysis. Question 2.1 is a depreciation straight line and diminishing balance. Okay, I think you probably find that one pretty straightforward. Huh? Okay? Everyone on the same page? Okay with that one? Okay. Quite a few examples we've gone through on that. 2.2. All right, so you actually have an example of that in your study guide, that you need to award points, right? Points for each employee and for each, if I recall, 1 million of liabilities, okay? And depending on the outcome of that, then you either use IFRS or IFRS for small and medium enterprises, okay? Now you ask me what's the difference? The major difference really is that IFRS is a very complex, it can be very complex, right? It's very complex. So what they try and do is that if your business is of a certain size, they allow you to use a more, how can I put it, not abridged, but a simpler form of IFRS, right? So that's all that means, okay? Because I mean, if I'm running a small restaurant, should I be using the same IFRS that Sasol uses? A multi-billion-dollar company versus my restaurant. Surely the administrative burden and the accounting burden should not be the same, right? I'm not listed. I'm not a public entity, right? So to go and spend all that money doing IFRS for my small company versus a Sasol, that's the reason. So that's the reason why there's IFRS for small and medium enterprises. Okay. Okay, 2.3 is actually quite an interesting one. I've had a few questions on this one. Anyone tried this question yet? You were okay with it? Okay, I think the thing to remember on this question is that you have a ratio that's a profit margin, 3%, right? And you have an asset turnover which is 1.7 times, not 1.7%, 1.7 times. Okay? So I think that is an issue that you just need to work out in your own minds, is that you have a ratio, so 1:2 or 2:1. In this instance, 1.7 times. Okay? And you've got a net profit margin percentage. So it's too difficult. Then they throw in a debt equity ratio of 40. So I'm not going to tell you what to do with that debt equity ratio, but you might or might not need it in the actual question. Okay, so net profit percentage. What is the formula for net profit percentage?
Profit after tax.
Right, so your net profit, right? So let's say your profit after tax
Divided by sales.
divided by total sales. So you know that you're given that, right? So this is 3%. Okay? Profit after tax divided by sales. Asset turnover.
Sales over its total
Sales over.
assets.
Right? So you're given that answer as 1.7 times. All right? So that what this means is that your sales was 1.7 times your total assets. Right? Does you understand that? Right? So as an example, if your sales was 170 and your total assets were 100, that ratio would give you 1.7 times. So your sales was 1.7 times larger than your total assets. Okay? All right, so that's the information you're given. You need to work with those two then to come to the answer. What is you're asked to do? Return on assets. The formula for return on assets? So really what they're asking is they're asking you to substitute, right? They're giving you two ratios, and they're actually asking you to work out the third one. Okay? Can you see that? Do we have profit after tax? Yes. Do we have total assets? Yes. We have sales as a numerator, and we have sales as a denominator. Okay, without giving it away further, right? That's what you're going to work with. Okay. Okay. Question 2.4. Calculate the company's expected debt to equity ratio. Okay. So you're given quite a bit of information for this question, and they say calculate the debt equity. Right? So debt equity, simple, right? So we have to utilize this information to get to the debt equity ratio. Okay, remember that other example that we worked through. We had debt of 3 as to equity of 5, right? So it was 1 as to 1.67, right? Okay. So this is what we're being asked to calculate with the information here. So it's very similar to the previous question. We're given quite a few ratios here. We need to work with those ratios to get to the debt equity. So we once again given asset turnover is equal to 1.2 times. Right? What is the formula for asset turnover? So asset turnover we said was sales. Right, so we're given that piece of information. We are given the debt, okay? Right, we are given debt here as 20 million. Right? What is our accounting equation? Right? So we already given, in this equation, we already know one number, 20. Okay? Here we know information as well that we're given a sales revenue of 60 million. Okay, there I've given you the information to work it out, right? Well, I haven't given it to you. The question has given it to you. You asked to do debt equity. You're given the 20 million debt number. You're given asset turnover of 1.2 times. We know that the formula for asset turnover is sales divided by total assets, right? We're given the sales number of 60. So we know 60 over total assets is equal to 1.2, right? So total assets, therefore, is equal to 50. So you know your total assets, you know your total debt. Quite easy to work out the other one, right? Okay. Question 2.5, current ratio. Okay, I think that's a pretty simple one, the current ratio. Question 3, capital budgeting. Right, similar to what we've done previously. So we know what the investment amount is. We know what the cash generated back is. We know what the discount rate is, 15%. Okay. They ask for the NPV. And what interpretation would we use for NPV? Okay. If NPV is greater than 1 or greater than 0, we'd go ahead, right? Payback period. Okay, so just remember on payback period, we can do a simple payback period and we can do the discounted payback period. You're given enough information in this question to do the discounted payback period as well. Any questions thus far on this? Is it also a case of that you haven't quite started it or you only started it, that as you go through it, you're going to then have questions? So my comment is the same then earlier. Work through it. If you've got some specific questions, come through to me. Happy to address them. Okay?
So, in terms of 2.5, I'm kind of confused in terms of the current assets. Do I also include land and building?
Okay, so that's part of the thing that you need to work out, right? So remember, current. Okay? Okay, current. You okay? Okay, cool. All right, 3.3, similar question to the HCBM, asking for a NPV and a RR calculation. And then you need to do a little bit of research on what the NPV means in terms of its outcome and what does RR mean in terms of its outcome. Okay? Question 4, cost of capital. They're asking for CAPM. We've covered CAPM quite a bit, right? We know the formula for CAPM, what we need to substitute. Okay? Question 4.2, they're asking for Gordon's growth model. Once again, remember it's D1. Dividend next year over the current year price. And then they ask you to discuss the differences between CAPM and dividend growth model. Okay? All right, and then question 5 is time value of money. Once again, they're asking to calculate the interest. Okay? So there they're asking you to do a compounded monthly versus an annual return. And 5.2, a zero coupon. Okay, what does a zero coupon mean? Okay, a zero coupon means that your return on the bond, on the investment, is actually 0%. Right? So typically we'd say, well, if we have an investment, we get 10% return. In this instance, they've got a zero coupon, meaning a zero interest rate. Okay.
So isn't that
Sorry?
isn't that pointless?
Good. That's a good question. That in terms of why would you invest into a zero coupon bond? One of the reasons why you'd consider a zero coupon bond is where the value of money is dropping, right? So you're happy to invest 100,000 today and get 100,000 back next year, so that there's been no reduction in the actual amount. Particularly in times when we have deflation, when your money decreases. Okay. So yeah, that's a right good question. But there is a room for zero coupon bonds. Yeah. All right, any questions? Please explain 3.2. Okay. So they're asking for payback period. If you remember this example here, the simple payback period is when does our cash inflows equal our investment? So in this instance, it was 56, 24, and 10. So our payback period was 2.5 years. That's simple payback. But we also should use discounted payback. So we need to look at the time value of money. When do we get back our money? And you can see on the discounted payback period was quite a bit longer. It was 4 years versus 2.5 years. Okay. You can, I mean, layout is up to you, okay? Whatever works for you. This just worked for me to highlight the example. If it works for you, set it out like this. Yeah.
Question 4. The information figure is too much. So necessarily use the tax rate, because I don't see it on this board.
Yeah. So remember, where did we use the tax rate? Cost of debt or cost of equity? Remember, cost of debt. Yeah. So you work with the information that you're given. Use what you need. Use. All right. I think the attendance register is going around. Please sign it. And then, as I say, tomorrow I'm available to work through some specific questions you have. All right? So please come with him. I'm happy to help. Thank you.